morning, everybody. Dan Kautz.
Good morning, Jeff Buckley.
And here we are in March. Came in like a lion, didn't it?
It sure did.
Yeah, boy. Let's see if it leaves as a lamb, and I highly doubt it.
Yeah.
But
yes.
a few things to talk about. Some developments have happened this month. We've had some turbulence that we talked about. I just didn't think it would be because of a war or a conflict or.
It's where we are right
where
now.
We are.
Yeah, we're just in the as we record this, just in the first few days.
Yeah.
So we're going to see. It's already had a pretty significant impact on the financial markets. So
yeah,
we'll see how it plays out.
But there's no doubt. You're saying, it's time in the market.
That's right.
Not timing the market.
Yeah.
So let's get to it. As you know, this is my slide here. A quick check-in call. We can't take any calls or texts during this recording. Our contact information is dkautz@kautzbuckley.com, jbuckley@kautzbuckley.com. Office phone number 716-276-8480. Ever popular text line 716-272-1129. I stress, please, all our friends and family out there, we love you dearly. But if we got to talk business, text us on the text line, not on our personal lines. You guys have been really good about that, but I always want to make this disclaimer so compliance knows that we're reaching out to our clients to tell them to do that. Always follow us on our socials here. We're getting some good feedback on that stuff. We really appreciate that. So let's jump into it, Jeff. What do you got here?
Yeah, well, this first chart again, this is our look a little bit in the rearview mirror. Just see how we've been moving along through the first couple months of 2026, and it's been pretty positive. We had pretty good January, a little bit of volatility in February, but finished out the month pretty well. So you can kind of see, I mean, the year-to-date numbers already are pretty good. But something that's kind of interesting is that we've moved a little bit, and Dan and I have been talking about this for months now. We want to see a little bit more diversification throughout the market, the market breadth. We want to see people showing interest in stocks of different sizes, large, medium, small, and also domestic companies, international companies. And we're seeing that a lot. I mean, the year-to-date numbers through the first 2 months, mid-sized companies have really excelled. The equal weight, that stands the S&P 500 equal weight, rather than being a capitalization size weighted index, the S&P 500. So when you have NVIDIA in there, it's such a large company, it kind of skews the numbers of the S&P 500 toward its performance. Whereas when you look at the equal weight, it's the same S&P 500, the Standard & Poor's 500, the same 500 stocks, but each one gets an equal weight in the index. So what we're seeing is, year to date, through the first 2 months, we were up about 7% on that equal weight index. So it shows people are starting to move away from investing exclusively almost in those high-tech companies, the Magnificent Seven. In fact, they're listed here at the bottom. And you can see money was really pulled out of those. The Apple, Microsoft, Google, and really spread across the market. So that's a healthy sign. We're seeing some market breadth there. The next slide, really, again, the look in the rearview mirror through the first 2 months, but we're looking now specifically at sectors of the economy. And surprisingly, not necessarily a great sign. We don't always want to see utilities leading the way. Because utilities are usually considered a very defensive sector because utilities, for the most part, are regulated industries. And so people invest in utilities for the income, the dividends that they pay out and the income that they generate. So it is showing that people are a little bit on the defensive side. Energy has certainly blossomed as well here. But yeah, discretionary, when we look to the bottom of the chart, that does give us a little bit of concern. The consumer discretionary sector is one of the weakest. And
that's where you want to spend your extra money. That's when you feel good. You're going to go out to the restaurants. You're going to buy that extra thing.
Right.
Now it seems to be we're getting defensive, pocketing some money.
Yes, taking some profits.
Yes. This may be a telling
Yeah.
slide. We will see. But it has been interesting the last few months as we've been doing this to watch that sector rotate. This has been, it's active.
Oh, definitely. Yes.
There's no one that's just holding that top position time and time again, just like the Buffalo Sabres are.
That's right. Go Sabres. Yes. Now this is kind of our look out the windshield, right in front of us, or currently what's happening here. We use this slide because Dan and I know the previous two that we showed you were focused exclusively on stocks, and none of our clients have all of their money solely invested in stocks. We use diversification, so we use the different size of stocks, different categories, but also we include bonds in there as well. And bonds have been performing pretty well lately, generating a nice yield. So this chart gives us the opportunity to show you how a balanced allocation will look, and whether you're more aggressive, 80% equities or stocks, 20% fixed income, down to the bottom, which is, 20% equities, so much more conservative, 80% fixed income, and then a few different allocations in between, just to give you an idea of where your portfolio may be, somewhere in this, probably most likely more in the middle categories, but how we're doing. Year-to-date returns have surprisingly been pretty consistent, because even with the most aggressive portfolio, you've only recognized about a 1% increase, I guess, over someone that's much more conservative, because again, bonds have been holding up very well.
Yeah, and that's when you want to take a look at. Oh, I'm sorry, we don't have standard deviation on here. I'm sorry, I thought we had risk on here.
No. It's just, this is just really just the performance.
Right. Sorry about that.
No, that's all right. But it does show here. Then certainly, when we go back 12 months, though, the performance that we've had going back a full year, the outperformance of the equity or the stock market, even though bonds have done well, if you're more slanted toward bonds, your returns have been a little bit more muted versus those that are a little bit more aggressive, taking a little bit of a bigger bite out of that equity market. Mm-hmm. They've been rewarded, certainly. And whether that continues or not, we'll see. But it's certainly paid off going back 12 months. And even really the 3-year return, a little bit more of a
right. That's what I was trying to point out is, you got the two sides of the coin, a portfolio, or an allocation that has 80% equities and 20% fixed income. Flip it over, 20% equities, 80% fixed income. Over 3 years, you get a 6.4 versus a 16.82. That's significant.
Right.
But you see how it's getting tighter? All right. And then on top of it, just take a look at the top 3 allocations where your rate of return versus how much you're putting into equities, you're getting tighter and tighter. So I think we're getting farther out on that risk, the efficient frontier right now. We're squeezing a lot out of the lemon, we're getting a lot of juice out of the orange right now. I don't want to use the word lemon.
Yes, that's right.
So we're getting a little more juice out of the squeeze, let's say. But we again, this goes back to the earlier slide where defensives are beginning, or utilities are beginning to get up, discretions are down.
Right.
Are we getting more juice for the squeeze? I don't think we're going to have as robust as a market as we've had in the last few years.
Right. Things are definitely changing at this point, we're working with all our money managers staying on top of that. But just to kind of sum this slide up, I mean, again, most of our clients are somewhere closer to the middle of this chart, but it's still been very positive.
Yes,
if you look, a 12-month return on a 65% equity allocation, 35% fixed income or bond allocation, you're still last year, or the 1-year return, 16.5%, almost 16.5%.
That's good.
3 years, and this is per year, 14.19%. Right. So markets have been performing well, but we're entering a difficult time, I believe. So.
Well, look, we just say that. Now look at the speedometers. Almost the most green we've seen in a little while.
That's true.
Specifically down on the bottom right corner there. Red went to yellow.
Well, this is interesting, the timing, too, because this comes out at the beginning of the month. And again, this is one of our money managers that we work with, Rockdale. They put this out, and it's to look farther down the road, out that windshield, 6 to 9 months. And this was before, though, the strikes in Iran. But the U.S. economic outlook increased significantly, really. We moved from somewhat pretty yellow to we're well into the green now. And we're going to touch on that as we go through these slides. The underlying economy still seems to be in a pretty good position, at least for the United States, and I think even internationally too. So we're just going to have to kind of see how this shakes out. But obviously, I think the geopolitical risk next month is going to look a lot different. Probably a lot more red.
And the last time we looked at this slide, we talked about consumer sentiment, consumer spending, and they were a little out of whack. You see how they're getting a little closer now?
Yeah.
And actions are matching our words now.
That's right.
So we'll see how this goes. I hate to say we'll see how it goes, but we really have no indication in the market to pull the emergency cord or anything of this nature.
Nothing at this point.
Right.
Yeah.
It's about having the fortitude
Right.
and a plan, not just a guess, and a
Yes.
plan, and
That's
not
right.
acting emotionally. So I'm done with all my words here today. Let's go. Here you go.
Well, this is just, with the attacks in Iran, I think right now what we were trying to just show is right out of the gate, what is global conflict? What kind of an impact does that have on the financial markets? And this is the S&P 500. So again, it's just the U.S. and it's also focused just on those S&P 500 stocks. So it doesn't include the entire financial market. But to give you an idea, I mean, these are just some of our more recent conflicts. For the most part, it clearly creates some volatility. But when you look really, the one that stands out when you look to the 12 months, the performance of the financial markets 12 months after that conflict began, Afghanistan, we had a pretty significant inflation problem. So that stands out as an issue there. But even before we invaded Afghanistan, we knew there was a problem there. But the rest have performed actually fairly well. And I think, it depends, it's a glass half full or glass half empty at this point. If this conflict can be resolved relatively quickly, if we end up with a regime in Iran that's more favorable, not just to the U.S., to the world, really. I mean, we're looking at a situation where, if they can become more of a global player, they're certainly a very large country, can be very economically powerful, have great energy reserves. If we can kind of steer everything in that direction.
Bring them in the fold is what you're trying to say?
Somewhat, yeah, but I mean, obviously they're going to still govern themselves. At least I think that's the plan at this point. We'll see, but the point is, though, that they've been somewhat of a bad actor. I don't think I'm out of line in saying that. Sponsoring, largest supporter of or sponsor of state terrorism, and it's not affected just the United States. It's affected a number of other countries, and if that comes online, down the road, this could really be a boon to an entire geographical region, really, in the Middle East. And I think that's the glass half full kind of perspective. The glass half empty, we're now dealing with an international conflict. It's drawing a number of countries in. It's choking off the oil supply in a very critical area. And we don't know how long it's going to last. And we don't know what the end game is either. So there's a lot of pros and cons at this point, but we'll kind of see how things shake out, I guess. So we'll see. I just kind of wanted to touch on this a little bit. The U.S.-Israel conflict with Iran could disrupt crude oil supplies and push prices higher for gasoline. Okay, so what does that mean to everyday Americans and to our economy? It takes about 6 weeks for crude oil to be processed and turned into gasoline for delivery. So right now, we're still within the first week of this conflict.
Right.
So we're not going to necessarily see that. The response at the pump that we've already seen is more just a
knee-jerk.
Yeah, it's the knee-jerk reaction. So, but it will start to work itself into the entire, really, the petroleum industry, the gasoline delivery and everything. So it's delayed, but it will be coming at some point. Consumers are likely to see some immediate effects at the pump at a time when many are already facing an affordability crisis. So this is going to have an impact. We just need to monitor it. We need to see how long that this conflict lasts, what kind of an impact it's going to have. Is it going to continue to be a significant impact? Are we going to get the Straits of Hormuz open and allow these shipments of oil and fertilizer and everything through there safely? Then maybe we can minimize this impact. But we're in early days at this point. So, the concern is a prolonged war. It could push up not only energy prices, but really affect a number of things across our economy. Markets already expect the Federal Reserve to be more attentive to inflation risk than it was in recent weeks. So we kind of entered the year and there was a lot of political pressure and thoughts that the Federal Reserve may cut the interest rates during the course of this kind of 12 calendar months, maybe 2 times. now we're starting to see, inflation
questionable.
maybe coming back into play. And if that's the case, then there's even thoughts out there kind of on the fringes that rates could start going the other direction to combat inflation.
Because remember, right, to combat inflation. To
Yeah.
get inflation's kryptonite to the U.S. economy, and how we beat inflation, we raise the interest
That's
rates.
right.
That's
That's
what
right.
has to happen.
Yeah.
So-
and then the longer the oil shock persists, the more pronounced the economic consequences will be. Right. So that's the critical issue right now is how long are we going to be in this situation? Now, I threw these numbers up here too as kind of, like I've said, with a little bit of a glass half full, glass half empty webinar this month, because these are the arguments coming from people that are more optimistic on our current status and where things stand. Tax refunds are about $775 higher this year for people claiming some of the new tax breaks that were put into place. It's seen that could be a stimulus to the economy and could help combat some of the affordability issues we're seeing, maybe some higher prices at the pump. That's one potential positive here. Unemployment. Now, as we record this, we just came out with some rather surprising numbers this morning, which went the opposite direction and actually pushed that unemployment rate higher. So that's a concern too. That's also a concern that the Federal Reserve might try to address in their battle with inflation. But when we look at the inflation point, now we'll see where the latest readings push us in this regard, but 2.4% headline inflation rate, and then the core inflation, which is really the guide that I think the Federal Reserve relies most upon, it's about 2.5%.
And
so
core inflation, if you just want to say it excludes what?
Yes, it excludes food and energy.
Right.
Yes, so but they monitor that very closely. So it's staying about really a pretty level point at this point in time. But the concern is that inflation is not. We're not showing progress moving down toward a 2% inflation rate, which is the Federal Reserve's stated target. So they may need to take further action in order to start the process of lowering inflation further and getting to that.
And the further action would be the raise of the interest rates.
Right.
So I want to be careful that we don't come off really negative about the market, because we're not. Are we cautious?
Yeah.
Yes. And what's very important here is we don't act emotionally. That's very important, because this is an emotional time. A lot of opinions are out there. Stay focused on the numbers, stay focused on a plan, and that we have it in place, and we have money managers that allow us to move the money as we see fit to either get out of the way of the train if need be, or to lean into the wind if we see the opportunity.
Right.
So,
and again, we'll reiterate it again. Very important. Time in the markets, not timing the markets. Everything that we've kind of talked about on these last couple slides are literally developments within the last couple weeks or months.
Right, it's moving fast.
Yes, it's moving fast, which means it's going to continue to move fast. And a month from now, things could be significantly different. Right. So we just need to stay on top of it.
So what's next?
Yeah, this is just kind of a wrap-up slide here, really. For the fourth quarter of 2025, S&P 500 companies reported year-over-year growth in earnings of 14.2%. That's very significant. And then the year-over-year growth in revenues of 9.4%. So when you think about the overall financial markets, yes, we've got stocks, we've got bonds, but the stock market is driven primarily by corporate earnings. And what we're seeing right now is companies are reporting strong growth in earnings, and that's very positive for the stock market. For the calendar year 2025, S&P 500 companies reporting year-over-year growth in earnings of 13.6%. So now we're going all the way back and looking at an entire year instead of just the most recent quarter. And year-over-year growth in revenues of 7.7%. Again, very strong, and now going back, looking at those numbers, a full 12-month period of time. So now look forward. The S&P 500 is expected to report, the companies that make up the S&P 500 expected to report earnings growth of 15% for calendar year 2026. That's over and above what we did in 2025. So in 2025, we showed you earlier, that was a pretty positive return for the overall stock market. So there are positive things out there. There are negative things out there.
Right.
So right now we're just kind of on heightened alert for all of these, and you should be too. And if you have questions or concerns, give us a call. We'll talk through any of this with you. We're in near constant contact with the money managers we work with, and any information we get, we pass it on to all of you as our clients through webinars or whatever it may be. So please, don't reach out if you do have concerns.
Thank you, Jeff, and I think it was a great job. This will be the beginning of March. Next month is, it's April. Is that how it goes?
Yeah.
So we'll catch you then. Until then, go Sabres. We're having a great season, and it's been very exciting here in Buffalo.
That's right.
Take care.
Thank you.